Hey everyone, Chaps here, and welcome to part 3 in our discussion about investments. In part 1, we discussed the different types of investment accounts. In part 2, we discussed the investment types. Now today, we're going to be talking about managing those investments. As the normal disclaimer here, I'm not a finance guru, check out the normal disclaimer down in the description, but let's hop into this. Let's start with what is probably the most expensive method of managing your investments, and that is probably through a managed account, as in someone else is managing your money, or at least a portion of it. Depending on the level of service you're going after, this can vary greatly in cost. The costs are typically taken as a percentage of your account's value. That means the larger your account is, the more you're paying. It also means that even if the account is losing money, as most people did in 2022, you're still paying the manager some fees. While this is likely to be a more expensive option, there are many who believe it's worth it. An obvious benefit with using this method is that the manager is likely to know more about investments than you do, and they probably even have a team managing tons of investments, and that team certainly knows more about the investments than you do. You can hopefully rest assured that your money's in good hands, and you can be relatively hands-off. The manager will likely work with you to understand your goals and timetables. They can then help balance the risk levels in the account. This is something that really shouldn't be overlooked. Yes, they are the ones managing your money, but they're doing it in a way that reflects you and what you are looking for. Better yet, they're also acting as a sounding board. Don't just think of them as a money mover. Think of them as managing your investments, but also being a financial advisor, someone that you can talk to if you have finance-related questions. Another great benefit with these advisors is something called tax loss harvesting. I won't go into all of the details here, but essentially it's a way to manage assets in order to offset some of the capital gains that you'll be owing come tax time. It's providing a short-term benefit now and pushing some of the taxes until later in life. Tax loss harvesting has its pros and its cons, and it's not for everyone. It can also vary greatly in how complicated it is. It's something that financial advisors will push very heavily as why you should work with them. But they're probably making things way more complicated and going very deep in it. You can also do it yourself and keep it relatively simple. It's not for everyone though, so just do your homework and see if it's right for you. Let's step back to a slightly newer form of account management, and that's Robo Advisors. You've probably heard of things like Betterment, Acorns, Wealthfront, or even companies like Vanguard and Fidelity offering their own Robo Advisors. All of these advisors have different services and expenses associated with those services. Some will connect you with a real person advisor to review stuff, and then set things up so the robo investor can do the rest. Sometimes the program will just ask you for some inputs and then set things up itself. Some robo advisors will do tax loss harvesting for you, and some won't. And just as with the managed account, you're going to have a wide range of fees here depending on the level of service. I think these accounts work best for those who don't really want to dive into and understand investment, but they also don't want to pay the additional costs that are typically associated with a fully managed account. That said, there's still a big category left, and that's self-management. This scares many people away, and it scared me away for a really long time because people feel like it's going to be overcomplicated. And you know what? I'm here to tell you that it really doesn't have to be that bad. I mean, yeah, it can be that bad. You can make it as complicated as you want, but it doesn't need to be that complicated. Managing stuff personally can allow for the most complicated options on your end, but it can also be relatively hands-off. It's also going to be your lowest cost option. Here, I primarily want to focus on the hands-off side of things. If you're watching this video, you're probably not the type of person who wants to go hands-on and make it extremely complicated. You probably want to keep it pretty simple. That's also the audience that seems to typically lean away from self-management, but I do feel like it's the audience that could probably greatly benefit from it. So in the spirit of keeping it simple, let's just start by throwing out tax loss harvesting. I mean, you can research it, and you can do it yourself if you want, but there's a lot of people who don't bother with that, so let's just assume you pass on that for now. Next, there's the aspect of adding money to the account. Some people like how the robo-advisors can do things like round up your purchases and deposit that into your account. This often doesn't add up to much though, and you're likely going to need to perform some manual transfers along the way in order to stay on track. And honestly, it really isn't that much work to pick a few times a year or even once a month and just move some money over to your investment accounts. You also have more control this way. Hey, if you wanted to, most brokerage sites will let you set up some automatic deposits. Like once a month, take $500 from my bank account and put it in my investment account. That's certainly an easy method, but you definitely want to be careful and ensure that you're not overdrafting, and the time that you deposit might also be timing the market terribly, so I personally don't set up any automatic transfers. Depositing is the easy part. What about actually investing? Well, I'm here to tell you the good news. It's very easy to invest in stocks, bonds, ETFs, mutual funds, or whatever you want. Many sites are also even going to waive a bunch of fees, like the fee for purchasing an ETF. Fidelity doesn't charge for that. And you can also purchase partial shares from some places, in case you don't want to buy an entire share. As for selecting what to invest in, it really comes down to balancing risk. I'll pull up FXAIX, Fidelity's Fortune 500 Index Fund. This is a pretty common fund that people discuss, but I just want to use it to show some things to look for. At the top here, you see some pretty helpful information. We have the Morningstar rating. Really, it's just a third-party rating of this investment. Next, we see a rating for returns. How much does this make relative to the rest of the market? Expenses, how expensive is this to own? And risk, how risky is it? Then over to this side, we see what is probably the most important information. How has it performed over the years? Granted, right now it looks terrible because, well, COVID and stuff. But seeing how funds typically perform is very important. Investments are all about long-term growth. Moving down to the next section, we can see that it's listed as a large blend fund. I can get more detail on this in the composition tab where we see the style map. Remember, as we discussed in the previous video, typically the top left is lower risk and lower return, and the bottom right is higher risk and higher return. Back to the summary, the next thing I look at is the expense ratio. The lower this is, the better. This is the percentage of your fund's value that you owe each year. Think of it like a management fee. For example, if I had $100,000 in FXAIX, I'd owe them $15 this year. So $15 on $100,000, that's a very low expense ratio. Some other things like the turnover rate and net assets are nice to see. Like net assets, you can see how big the portfolio is. Are a lot of people using this one, meaning it's probably a good one. But really, it's the star rating, historical trends, that category, and expense ratio that I really look at. While those are the main ones, there's one other thing that I also definitely take a look at, and that's the fees and distribution tab. I like to look at the dividend history and capital gains history. It gets sort of complicated comparing different funds here, but generally I like to see lower numbers here. Basically meaning that I'll owe less in taxes up front or along the way, and I'll defer them until retirement. Again, looking at this tab is sort of extra. The other things I mentioned are way more important for most people. I just sort of use this as a last measure to look at when comparing a couple funds. So that tells us the information about the funds, but I still don't know which funds to invest in or when to invest. And welcome to the club. Nobody knows. Nobody can predict the future. So you're just like everyone else. And that's probably the scary thing that's turning a lot of people off from wanting to manage funds themselves. In general, for which funds to invest in, you can look at it this way. The further out retirement is, the more money you can put into stocks. And no, that doesn't mean straight up just buying stocks. That also includes things like ETFs or mutual funds that contain stocks. Back over on that composition page with the style map, if we scroll down, we can see a fund's composition. FXAIX, for example, is almost 100% stocks with 0% bonds. Other funds like FTBFX focus more heavily on bonds, and funds like that are where you'd start to shift focus as you near retirement. What this really means is that as you get closer to retirement, you shift more and more of your funds into lower risk investments. When you're young, you can handle a market crash or a downturn like these past few years because you know historically the market always recovers and then continues to grow. In retirement, it's a little bit harder to ride out because you're slowly draining your funds. You always hear buy low, sell high. Well, in retirement, you might not be able to control when you sell, and if you happen to be in a market downturn when you need to take some funds out, you're taking quite a hit. So how do you balance it? How do we figure out the proper risk level? Well, two of the most common allocation recommendations that I've seen are something like this. Bonds equals age minus 20, which is essentially the same as stocks equals 120 minus age. Or the other option, stocks equals 100 minus age, which is the same as bonds equals age. So if you're 45, the first method says bonds equals 25% and stocks for the remaining 75%. The second method says stocks for 55% and bonds for the remaining 45%. So chances are, if you're 45, you should be somewhere in that zone. A big factor that's going to determine where you fall in this range, or really if this range is even right for you, is how much you plan to pass down in inheritance. If you're planning on using most of the funds yourself and not really passing much down as inheritance, then that 100 minus age is probably a more fitting thing to use. I'll also add that this is definitely a spot where having someone who manages your account for you can really come in clutch. If someone's managing that account, they can work with you to figure out what the right risk level is. Also, even if you're not working with someone who's managing your investments, having a financial advisor there who can tell you the proper risk level or work with you in order to figure out what your proper risk level is going to be really nice. Things are going to change in your life, not just getting closer to retirement, but life events like having a kid or medical expenses. So having someone there to talk through the levels of risk and help find the right balance for you is really going to pay off in the long run. Okay, so you know how to balance your risk levels, but which actual funds do you invest in? Well, I, again, can't predict the future. I can't tell you what's best. I will say I'm someone who's rather hands-off, so I would suggest some index funds. More specifically, the Boglehead methodology, which is really the pinnacle of hands-off investing. I'm actually working on a video about that, so keep an eye out for that. That should be out soon. And another thing, to be clear here, hands-off investing, or managing the funds yourself, is not for everyone. I personally like it, and I think if you're willing to put in a little bit of time, it will really pay off. But I know a lot of people who use Robo Advisors and are very happy with that. And I know a lot of people, including some of my family, who have professionally managed accounts and are very happy with that. So just weigh the options and figure out which one works best for you. Really figure out how much your time is worth. Figure out how much you'd be paying a Robo Advisor. Weigh the pros and cons of each option. And you know what? If you change your mind down the road, switch things up. It's not like you have to decide now and lock it in. Again, if you're interested in doing things yourself, I would definitely look into the Boglehead methodology and check out the video that I'll be putting out on that soon. Make sure you subscribe so that you don't miss that. If you have any questions or comments about anything discussed here, or just finance in general, or life in general, comment down below or hit me up on Twitter. Thanks for watching, everyone, and I'll catch you next time.